Imagine a company that once promised the moon with its electric vehicles, only to now tread cautiously on the ground. Lucid Group, the electric vehicle manufacturer, has just shaken up its production plans for the year, revealing a more conservative forecast than previously announced. This shift comes after its second quarter results fell short of Wall Street's expectations, sparking questions about its path forward. But here's where it gets controversial. While the company is scaling back its production targets, it's also securing a $300 million investment from Uber to build a fleet of robotaxis. Can these two moves coexist, or is Lucid playing a high-stakes game of catch-up? Let's break it down. Lucid now projects manufacturing between 18,000 and 20,000 vehicles in 2025, down from its earlier goal of 20,000. Interim CEO Marc Winterhoff, speaking to CNBC, admitted the year has been full of surprises, prompting the company to adopt a more cautious stance. "We're still aiming for the upper end of that range," he said, "but we want to be realistic about the challenges ahead." Shares of Lucid plummeted over 7% in after-hours trading, reflecting investor concerns. The numbers tell a story of struggle. For the quarter ending June 30, Lucid reported a 24-cent adjusted loss per share, worse than the 21-cent loss analysts had predicted. Revenue came in at $259 million, below the $280 million forecast. The company's net loss for the period was $855 million, or 28 cents per share, a slight improvement from the $790 million loss in the same period last year. However, costs and expenses surged 7.5% year-over-year to $1.06 billion, while total liquidity stood at $4.86 billion as of the end of the quarter. Chief Financial Officer Taoufik Boussaid emphasized the company's focus on disciplined cost management and brand building, particularly as it ramps up production of its Gravity SUV. But here's the catch. Lucid is still grappling with supply chain bottlenecks, and Winterhoff admitted he hoped to be further along in scaling up the Gravity's production by now. Meanwhile, the company delivered 3,309 vehicles in the second quarter, a 38.2% increase from 2024, but still below analyst expectations. And this is the part most people miss. The broader EV market is facing headwinds. Consumer demand for pure electric vehicles has lagged, with many opting for cheaper hybrids instead. Compounding the issue, President Donald Trump's new tax and spending bill, signed into law on July 4th, will phase out the $7,500 tax credit for new EVs and the $4,000 credit for used ones by September 30th. This policy shift could further dampen sales, raising the question, is Lucid's partnership with Uber enough to offset these challenges? Or is the EV market entering a prolonged slowdown? Lucid's stock has already dropped nearly 19% this year, and the road ahead looks rocky. While the Uber investment and Timothée Chalamet's high-profile ad campaign signal a push to boost brand visibility, the company's financials tell a different story. So, what do you think? Is Lucid's strategy a bold gamble worth backing, or is it a sign of deeper structural issues in the EV industry? Share your thoughts in the comments. Let's debate whether this is a temporary setback or a turning point for the company.